So a couple of months ago, I made a video talking about 4 dividend stocks that I wanted to sell out of, and so far, I've given the boot to 2 of them. I sold out of both JEPI and Intel, fortunately for at least a small total return on both of them, but there are still 2 remaining stocks I'm hoping to sell out of, and those are AT&T and Verizon. These were 2 of the first dividend stocks I ever bought, and as I'm sure you can imagine, when first starting out, I didn't really know what I was looking for, and I didn't know what made for a good investment, but when it came to these 2, all I saw really was the high dividend yield. When I first invested in these companies, I didn't understand just how capital intensive they are to run and maintain, and I didn't realize how much debt comes with the territory. Both of these companies are carrying hundreds of billions of dollars of debt on their balance sheets, and that will likely always be the case. The reason for this is because they constantly have to spend money to maintain and upgrade their infrastructure, and that requires a lot of money, which they often finance with debt, and that's just the nature of how these businesses operate. Having said that, I don't think either of these companies are a good fit for my portfolio any longer, and even though I think they'll continue to be steady paying high yielders, I think there are much better ways to invest that money in my portfolio, so that's what I'm gonna do. And truth be told, I probably should have sold out of both of these already, and I'm definitely going to do it soon, I really am, but I'm just being stubborn and I'm waiting for something that may never happen. I'm taking a closer look at both my AT&T and Verizon positions over here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download the spreadsheet in the description of the video. I hope you check it out. But anyway, looking at both of my positions here, with AT&T I have 101.5 shares, with Verizon I have 43.9 shares. And looking at the average cost, they are both quite a bit above the current share price, so I'm seeing a pretty decent loss on both of these positions. In terms of share price, with AT&T I'm down 21.75%, with Verizon I'm down closer to 22%, but they're really not too far off from each other, and if we include dividends in the calculation, the situation looks a lot better. On a total return basis, I'm down 4.3% with AT&T, really not a bad loss, and with Verizon I'm down 10.33%. But what I'm stubbornly waiting for is for both of these to get back in the green, and I definitely don't expect for that to happen if we're just talking about the share price, but I look at the total return and I think, you know, down about 4% with AT&T, that's really not too bad, so it could happen. But every time I have that thought, I always go back to this one quote that Russ always says. I think it's like his favorite quote. He says, "You don't have to make it back the same way you lost it." I love that, and I definitely think it applies here. At the end of the day, it's probably best to just rip the band-aid off and sell AT&T and Verizon, even though I'm down on both of them, so I can unlock that money and reinvest those funds into something that I think is going to generate a higher total return over the long run, and then I can recoup my losses that way. Fortunately, though, neither of these are big positions in the portfolio. They both make up only about 3% each, so the losses I'll incur upon selling won't completely ruin my life, which is good. But anyway, those are the 2 stocks that I definitely plan on selling out of, and there's actually a couple more that I've considered adding to the chopping block as well, but for totally different reasons. The other day, I was watching this video from my guy Lanny, where he's talking about how he has over 70 individual stock positions in his portfolio, which is a lot, and he wasn't too thrilled about that number. In a tweet, he calls all that diversification unacceptable. That's just too many stocks, he says, and in the video, he tells us exactly how he came to have over 70 positions, and I think what he describes is something that many investors go through, especially when first starting out. Early on in your investing journey, like I would say probably those first couple of years at least, when you buy stocks, you're probably not buying a ton of shares at once. You're probably buying it little by little, you know, half a share here, maybe half a share there. And as you go along, you keep finding these undervalued stocks. You know, they're hard to say no to. We dividend investors love a good discount, but you know, you keep finding these different things to add to. And so you start a new position and you slowly add to it little by little. And maybe you repeat this process across 20, 25, 30 different stocks, or maybe even more. But either way, you've built quite the diversified portfolio with all these different holdings. And being diversified isn't necessarily a bad thing, but what usually happens is that over time, the stock prices will go up, which is good. But as a result, sometimes you'll stop investing in these little positions that you've built out because the share price has gotten so far away from your cost basis and it's just gotten way above where you started buying it in the first place. And then you won't want to buy anymore because you don't want to raise your cost basis, but then years go by and you find yourself with all these relatively small positions that you probably won't add to anymore. And as your portfolio grows, these positions will become less impactful as an even smaller percentage of your overall portfolio. Anyway, that's the essence of what Lanny was talking about, and it hit me like a ton of bricks because I think I've caught a couple of these positions in my portfolio. You know, these small positions that have actually done really well for me, but I question whether or not they're worth keeping in the portfolio over the long term. And the first one that comes to mind is Southern Company, which is the smallest position in my main account, only making up about 2.2% of its total total weighting. And looking a bit more into my Southern Company position, I have 17.87 shares at an average cost that's just a hair above $60. And with the current share price of $67.50, I'm up quite a bit. And if we scroll over looking at my returns, I'm up about 12.5% in terms of share price, and I'm up almost 25% on a total return basis. So overall, this stock has done really well for me. But overall, I just don't see this as being a position that's going to move the needle in the portfolio over the years. And it's only a matter of time before this 2.2% weighting becomes less than 2%, and then 1.5%, and so on and so forth as I add to all these other positions. And sure, I could always add more to Southern Company to prevent that from happening, but realistically, I don't see myself doing that. I haven't added anything to this position since my first few initial tranches back in 2021. And these days I look around my portfolio and just see so many other companies I'd rather contribute money to. So yeah, Southern Company might be on the chopping block. But anyway, moving on to this next stock, believe it or not, Coca-Cola might also be on the chopping block. And this one would actually be really hard for me to sell because it's such an iconic business. But it's the same thing as Southern Company. I mean, Coca-Cola is not even 2.5% of my portfolio. And like with Southern Company, based on my historical purchases, I just don't see this being a company I plan to add any more to, at least like not a meaningful amount. There are just so many other companies I would rather invest in. And taking a look at my Coca-Cola position, I have 23.25 shares at an average cost of $51.50 with a current share price of $59.35. I'm also seeing a pretty decent gain with Coca-Cola. I'm up 15.2% just in terms of share price, but including dividends, I'm up 25.3%. So once again, this one's doing really well. Like I said though, at 2.5% of the portfolio, and this number will probably go down over time, I just don't see this as being a position that's going to move the needle in a meaningful way across a long period of time. And if we scroll over looking at the dividend stats, I feel the same way in that department as well. The yield's at 3.23%, which is not bad, and the dividend growth rate is actually pretty identical to the dividend yield, but I think I can do better in both of these departments. I think I could reinvest that money into something with either a higher yield and or a higher dividend growth rate, because I have multiple companies in my portfolio that offer a higher number in both departments. Like I said though, Coca-Cola would be such a tough one to sell. It is such a stalwart, and I think holding on to it does add a bit of defense to the portfolio, which I do like. But then again, I have other larger positions like Procter & Gamble, for example, which is my third largest position, that offer the same benefit, and I would just rather add more to that. Now, hypothetically, let's say that I went ahead and did sell all four of these positions, AT&T, Verizon, Coca-Cola, and Southern Company. This is what my portfolio would look like immediately upon selling. It would take the number of holdings in this account down from 21 to 17, which is something I would definitely welcome. I would very much be looking forward to consolidate, and I still think 17 different holdings is pretty well diversified. So that's one thing that would happen. Number two, it would take my projected annual dividend income down from $2,543 to about $300 less to just above $2,200. But once again, we still have all this cash on the side. Once we reinvest all that money, it would look a bit different. We'd, probably, hopefully wouldn't be too far off from that original number. But anyway, immediately upon selling, it would take the dividend yield in the portfolio down from 4.06% to about 3.5%, which is not too bad, still a pretty respectable yield. And the dividend growth rate in the portfolio would not hardly be changed. It'd go from 7.79% down to 7.76%. Nothing too crazy. And then last but not least, the cash position, guys, would just skyrocket. So at this time, I have $798 in cash sitting on the sidelines, ready to go in my brokerage account. But upon selling, it would take that to $6,821. So I would be able to go on a very nice shopping spree. And with all of that cash, I would slowly reinvest it back into the portfolio in the preceding months. Now, as far as exactly how I'd reinvest that money, I'm not 100% sure. But like I said, my goal would be to do it in a way that wouldn't result in me taking too many steps back in terms of my projected annual dividend income. I wouldn't want to lose too much income in the process. And as a hypothetical example, just for fun, if I did something like what we're looking at here, I think this would be a pretty good way to reinvest that money. I have 7 different stocks in front of me here that we're going to look at. We have EPD at the top, and I figure I'd invest 10% of that money, $682 into EPD, and at its current share price of $26.46, that would buy me almost 26 shares. And all of the stocks we're looking at, guys, we're going off the current share price, which is certainly bound to change over time, but it's the best number I had to work with, so I had to use it. But anyway, moving on to the second position that I would add to, Main Street Capital Corporation. I'd also invest 10% of my cash into that, and at a current share price of $44.42, I'd be able to buy 15.36 shares. Not too bad. Anyway, moving on to the third stock that I would invest in, you guys know I had to throw this one in there, Realty Income. If I invested 10% of the money into Realty Income at a current share price of $51.68, which is a pretty good time to buy in my opinion, I'd end up with an extra 13.2 shares. I love that. Anyway, moving on to stock number 4, guys. This one is Procter & Gamble. Like I said, this is my 3rd largest position. I'd love to be able to add more to Procter & Gamble. And if I invested 10% of the cash into that at a current share price of $156.54, I'd be able to get just over 4 extra shares. Moving on, stock number 5, you guys, how could I not include this one? Starbucks. If I invested 10% of the cash into Starbucks, so another $682 at its current share price at the time of recording, $94.35, I'd be able to add an extra 7.25 shares, which would officially put me over 50. It actually put me closer to 55 total shares. But anyway, moving on to the second to last stock, Snap-on. I haven't added anything to this company for such a long time. And admittedly, it is quite a bit above my current share price, but I'd still love the opportunity to add a little bit to it, especially since recently we did see a little bit of a pullback. It had a day where it was down like 9%. But anyway, I figure I could invest 20% of the cash into Snap-on, an extra $13.64. And at a current share price of $261.54, I'd be able to buy an extra 5.2 shares. Not too bad. And then last but not least, guys, Visa. I would dump the majority of the cash into Visa, just over $2,000, and at its current share price of $276.25, I'd be able to buy almost 7.5 shares of Visa. Nice. Now, I probably wouldn't end up doing it exactly like that. Like I said, that's just one hypothetical example, but I do like that scenario, and I think that's a pretty good way to go about it. And if I did, like hypothetically, if I did reinvest the cash exactly how I just described, this would be the final before and after of the portfolio. So before selling anything, we'd have 21 different positions, which once again would go down to 17. When all is said and done, the dividend yield would go from 4.06% down to 3.92% after all the cash is reinvested, which is still not bad. Sub 4%, I will take it, but the dividend growth rate, guys, definitely gets a nice boost here. We go from 7.8% up to 8.9%. So we're able to add a whole extra percentage point to that dividend growth rate. I love to see that. And obviously the cash position would go from its current place, about $800 down to hopefully $0 when it's all said and done. And last but not least, the projected annual dividend income would go from $2,543 to $2,450, which admittedly is a little bit lower than what I'd prefer, but I'll take it, guys. We can build that back up in no time, especially with the added boost from the higher dividend growth rate. I think that's more important from a long-term perspective. So that's what my portfolio could look like after making these moves. And overall, I'd say that's a pretty nice improvement. But if you want to see what my portfolio looks like right now in its entirety, then check out this next video right over here. In this one, I'm revealing my entire dividend stock portfolio, and I'm showing you every single one of my holdings along with the number of shares that I have of each position. And I'll also show you the gain and loss with each one as well. So click right over here to check that out, and I'll see you in the next one.